Why don't we start off with Bitcoin? I feel like Bitcoin's kind of had the biggest change this week. We finally broke through mid vamp. Momentum, upwards momentum has stopped. And now the question is, where do we go from here? Like, was this just a double top like we saw uh, back? When even was that? It was
December,
no, not that
January.
one. The big double top in 2021, 2022.
Oh, this?
Yeah. So that's the question. Like, is that kind of what we're seeing here?
I don't know. I don't think so. But obviously the regime's system models will guide there. But I want to just touch on the fact that ever since Bitcoin has flipped bullish trend, which is roughly a little over a month at this point, it failed to lose mid vamp at pretty much every attempt. There was two attempts here, failed, failed, failed to even take out like mid May lows, broke higher, new all time highs, booked there. And now we're back below mid vamp. So the base case here has to be like this. There's now a higher chance or a higher probability that you're going to experience some sort of chop as long as you're under mid vamp. And this type of chop, especially in crypto where there's a lot of leverage, can easily shake people out of positions that maybe they should, maybe they're too leveraged up in, they're trading too aggressively, and you can get liquidated out of a position where normally with less leverage you might be able to ride the trend better and capture more of the trade. So when we see price accept below mid vamp like this, it's just a very simple thing. Just be cautious. There might be some volatility, but it doesn't mean the bull trend is over.
Yeah. I mean, the regime that we're in still supports Bitcoin. It's not ideal. A slowdown regime isn't ideal for Bitcoin, but from a slowdown is what we need to look for. Like, where do we go from here? Because Bitcoin usually acts very quickly and ahead of time. So from a slowdown, a deflationary slowdown is what we're in. We can either go into expansion or we can go into deflation. And expansion, obviously, that's going to be good for Bitcoin. The slowdown also somewhat good for Bitcoin, but a little bit choppy and a bit more risky, just like how it is for equities. It's really deflation, like coming out of slowdown into deflation, that we need to look for. But at the moment, it really doesn't seem like growth expectations are dropping much. They're actually, in fact, kind of slowly moving higher or staying stagnant.
Yeah, it's a good point that you touch upon there, right? Because look, if growth isn't falling apart, the it, the base case always has to be bullish, especially on riskier assets that are designed to perform with growth, right? Because if your base case is bearish, better said this way, the economy is growing more than it's shrinking over the long run. So your base case has to be bullish on growth assets. Now, if growth impulses or growth isn't showing a material decline, you have to lean more bullish. So, like you said, yeah, just the stagnant growth impulses, as long as they're in slowdown territory, necessarily doesn't necessarily mean that the economy needs to really shrink. It just means that those high flying, risk on growth impulses aren't present, which means act cautiously or more reserved, but you could still act. You don't have to be completely taken off the playing board. You could still throw chips down. You just got to be very careful on how you bet and bet accordingly.
Yeah, because it is pretty easy to go from slowdown to deflation. Like it's really one headline away in this
In this market,
climate.
yeah,
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 it's
yeah,
pretty rough. So it's very important to be nimble and staying allocated into assets that give you safety, even if you do get that dip into a deflation territory, and that would be like safe assets, like healthcare, utilities, consumer staples, like those kind of things, which they do well in slowdowns. They do all right in expansion. Like everything moves up in expansion. Uh, you're just not gonna move up as much as the Nasdaq or the SPY would be moving, but at least you wouldn't be losing money. And if deflation ends up being the next regime, everything gets smoked except those safer holdings. So that's really that kind of the smarter play to do in this current environment.
Yeah, and the one caveat for Nasdaq risk assets, right, is like how we were just mentioning earlier, Bitcoin losing mid-vamp, which you could very well retrace this within a day, even a couple hours. It's now impossible. Nasdaq has also been holding mid-vamp or has held mid-vamp after going bullish trend. So this is and look at it today, literally pretty much the tick off of mid-vamp. So as long as we're above mid-vamp here, the base case, it's in a bullish trend, should be sideways to higher. The only reason we are not long Nasdaq at the moment is the regime signal is not confident that we are in a high flying risk on regime. And because we utilize 3 times leverage, it doesn't make sense for us to leverage up on whims. So we need that the confidence in our sales to really size up and take big swings on things like the Nasdaq with 3 times leverage.
Yeah. Something interesting to note that I actually just noticed is the vamps are closing in quite a bit today.
Oh yeah, I mean that's obviously a good sign because what's going on here is you could look at it like in this sense. Look, Nasdaq today is pretty much nowhere or little changed since 15 days ago, right? It's pretty much gone. It did a lot of work the first half of the month and then did pretty much nothing the back half of the month of May. So if I was just looking at this, volatility should be compressing and we should see things like VIX, somewhat down. Yeah, see VIX came down good part of the month, first part of the month, back half of the month been stabilizing. We're actually below the 20-point level on VIX. We're below 20. A break below here into the 15s would probably coincide with risk like legging up and Nasdaq legging up and really breaking up to all-time highs. That would probably yield an environment where VIX is falling even further, but it gets us down to a new range of say 15. That 20 to 15 range. We're still a little high in the 20s, but like if we gravitate more down toward more closer to the 15 level, I would assume that equities would love that. Now, not just equities, any asset with a risk component would likely love that. So think Nasdaq, S&P, Mag 7, utilities, staples, discretionary, pretty much everything would like that environment. And in that environment, if growth impulses really start accelerating, I think Nasdaq would lead the race there. But the problem is we're in a position right now where growth impulses are stagnating and they can go either way, but we're more towards the area of going back to risk on as per our models, but we're not necessarily confident either way. So again, we're in the slowdown regime, and that's a generic bounds it has a generic band, right? That you're going to fluctuate between, and we position accordingly to being in that band as an overall basis. We're not so like, oh, we're getting close to risk on. It's time to like start putting on risk on trades, or vice versa. We take the position as per the regime and keep it very simple. So until we're on risk on, we'll be watching the Nasdaq from the sidelines.
Yeah, but thankfully we're in Bitcoin. At least we have that risk component exposure.
Yeah, I mean Bitcoin's been doing pretty well. I mean RQF had a pretty decent bounce back in the month of May. We were experiencing. We could take a look here, right? Obviously, this is not going to update for the last day of the month, but let's take a look here on the seasonality chart for RQF. As you can see here, RQF is, go back to 2016. RQF is currently, I think it's the second worst, or let's see, second worst start to the year, going back to 2016, pretty much almost 10 years. So it's been a tough year for us so far, but I think that it's there's light on the horizon here because RQF's known and has historically made up for a lot of lost time on many of the years in the back half of the year. So we're not obviously giving up on this or sort of like scared or anything like that, but it's just one of those things that sometimes you have weaker starts to years than others, and given the volatility, the way the market's been moving, it's just been a pretty rough overall start. But we're making some headway in May. We crawl back like half the yearly losses. And if we get in June here, if we can get a nice solid trending month in our underlyings, we could probably even squeeze out positive year to date gains by the end of the month.
Yeah, and I really think we've been through the worst of it with the tariffs and the trade war and everything. Like, yeah, it's not going too good with China. I know that. But it's not really going to scare the market like it did the first time.
No, yeah, and I think our models, like, with all this drama and all this BS that hit the market, our models did hold up surprisingly well. Like, the right now we are in a 8%. It'll be less after this refreshes tonight, but we're in roughly a 7% drawdown for the year, right? We're down 7% since on the year, right? With RQF. 7% on on a strategy where 80% of the assets in the strategy are leveraged 3x. That's actually pretty good given the market's essentially flat for the year and it had like a 20 something percent drawdown midway.
Yeah. Yeah, like
So
7% drawdown can be made up in like one good day.
yeah, forget a month. You can make that up in like a day. He's right. Yeah, you can make it
Yeah.
up in a day.
That's the beauty of three times leverage.
Yeah, and controlling the drawdowns is key, right? I mean, look, like this could be a lot worse. That's the way I always look at this. Like we had pretty much one of the worst starts of the year in many, many years. Yet RQF is having its worst start of the year in the last 10 years. But on a relative basis, given the leverage, it's actually not, like down 8%, not bad at all, right? Down 7, 8%. I
Yeah,
think
like
what's going to end up happening.
when yearly upsides are like 50, 100%, like
Yeah,
8% is nothing.
no. And I think what likely happens here is the market did get spooked. The entire way, the entire path of how tariffs came to fruition, they were a bit aggressive, right? I mean, we went from poster board liberation day to walkbacks to reapply, resets, and then walkbacks on the resets, and it's been quite volatile to say the least. So, if there's any sort of structure that comes out of this, I think maybe that would add more confidence to the market than more than anything else, and that alone may get things just risk moving in a more functional and rhythmic manner. And I think we might be breaching that point. I mean, we had a bunch of tariff news this last week, right? We came into the week with some sort of tariff pause, right? Um, and then we ended the week with another set of steel tariffs to be implemented next week, right? And
Yeah, and then
it's just
we've got the courts that said these tariffs are not allowed, and then now they are allowed temporarily. So
well, yeah. I mean, the courts are ruling that the tariffs are unjust, but they're in appeal. I believe they're in appeals right now, which leaves them on until a later date. I think it's sometime next week. But
yeah,
ultimately, the point of what we're saying, or what I'm saying to you, and I guess what you're saying back to me, right, is that there's a bunch of noise, and the market's still able to pretty much stay level, right?
yeah.
We went from
I
taking
think
tariffs off, putting them back on,
yeah, the market's really seeming like it's getting desensitized.
which is honestly a good thing at this point because I feel like that's probably the next leg here. I mean, ultimately, I hope we go back to risk on. That's what I want. I think that's what everyone really wants. Like TQQQ and chill, man. That's it. Like, let's go. And I think that we might be getting to a place where that becomes more of a possibility, but I just don't think we're there yet in terms of growth impulses. There's still a lot of uncertainty, right? Just given the fact that there's news headlines every other day on global trade, I think it's just going to make it hard for there to be some sort of confident push in real strong growth impulses, which are going to be required for the risk on trade. But they could come. And if they do, we're going to act regardless of what our feelings say, what the market says, in terms of, or the media says, right, in terms of what's going on in the market. Our system is very data dependent, no emotion. So it says jump, we just say how high and execute, and that's
Yeah,
how we've been operating pretty much this entire time, and we're going to continue doing so. So, another area I think that we should touch upon is bonds because everyone's wondering what's going on here, and I think bonds are cooked for right now. But I keep saying this: bonds are cooked for right now, but they're not cooked forever. Um, and I think that's where we are right now. And I think the thing that's holding bonds back the most is the inflation swap spreads. So like if you look at the inflation swap spreads, you'll see like we're negative 40 basis points on twos minus tens. So 2 years or 2 year inflation swaps are trading like 40 basis points over 10-year inflation swaps. And that type of environment where it's negative and it's not really reverting higher, bonds don't like that. We saw this into like this whole tariff issue. We saw the swaps kind of like bouncing a bit right before Liberation Day. And then when Liberation Day hit, this thing imploded. And it's been pretty much hasn't recovered since. It's slowly starting to, but until this like trends up, I'd say like until this is like above the negative 20 mark and like trending up and looks like it wants to go back towards zero, I think that's like a good indication. And maybe I can get like some other time period here quickly to show you what I mean. Like when we're trending up like this, even if we're in negative territory and we're moving up towards zero line, in this case this is above zero. Nonetheless, if we're trending up, the bond market's going to think that deflationary pressures are more persistent, therefore bonds are going to actually like that. This type of stuff is just it's a lot. It's a huge chop risk. And if you buy bonds right here, what you're saying is you're betting that this is basically the low and it's going to basically one shot up and run way up, you know? And I think that to make that bet right now, given the just the political uncertainty, it's possible. If the system triggers, we will, but I think it's a very hard bet to make. And if you look at bonds in general, I mean, look at this. We got to pop like 5% just to get to Momo. So bonds are something that like if you're buying down here, you're basically trying to catch a bottom, and that's one thing that our models aren't capable of doing, and we don't have any aspirations of doing just because of how this looks fun, right? Like you're catching the low here, maybe you can catch the low here, maybe you catch the low here, but then like just go back and just know like this can happen to you.
Yeah.
So
And how
like
many people tried to catch the lows during that whole period?
we literally saw like people getting smoked left and right back in 22, 23 on bonds. Everyone was trying to call the lows, saying bonds rally, buy bonds, wear diamonds. It was crazy and smoked pretty much all across the road here. There were some small bounces, but never even got a bullish trend. So ultimately, yeah, look, this stuff picking bottoms is not for us. So until bonds are at least above at this point of where we are today, 90 points, maybe even higher on TLT, we're not interested. It's just a non-event for us. So I know some people are probably trying to catch the bottom. And if you're buying bonds for coupons, if you're buying bonds for the 3 to 4% coupon down here, look, that's a different story. If you want your 4% and you want to chill, that's a different game here. We're looking for leveraged capital appreciation. So for us, if the trend's not in favor, it's not for us. So I think that's where we'll leave off with bonds. And should we touch on utilities? You want to touch on utilities?
Sure, yeah. What do you got to say about it? It's to me it's looking pretty strong. Like we've got some
Utility.
strong basing happening, failing to break down. It trades so weird. I hate the way utilities trade. Like it seems like
Dude, it's
every
all
morning there's a fund
yeah,
out
I was
there
just
that's
gonna
just
say.
selling billions and then it catches
Dude,
up for the rest of the day.
it's almost like you can sell utilities at the close and buy them like 30 minutes after the open for a discount every single day.
Yeah. I
Like
know some of the
I
members
should
are
back
like
test that.
buying calls throughout the day, like after the first initial sell off, and then it rips into the close and it's easy money. And it's been doing that like every day.
Like let's see on a yeah, I mean like it literally if you sell the close and buy like the next day, like 15, 20 minutes in, almost every day, it's a dip. I mean, look, this short-term observation. There's a lot of bias there. Don't go out and try and execute that real time. I'm just saying we've been watching this quite a bit the last couple months, and it is quite annoying, but progressing higher, if that makes sense. So utilities look good. I think that in terms of the defensives, maybe Staples are probably the only other one that really look like Staples got that rocket ship look. I know it's
Oh
consumer
yeah.
staples. It's hard to say that, right? Rocket ship look on consumer staples, but I mean, look at this. It just looks good. It looks better than Nasdaq, honestly. Like Nasdaq looks stretched, right? Staples look just like they're chilling.
Yeah,
And
Staples just went sideways. They didn't even really drop
yeah.
much.
XLV, this has too much Trump risk, honestly. Too much MAHA or whatever, Make America Healthy Again risk here
Yeah.
with all the underlying biopharmaceutical companies and whatnot, and health insurances and all these things that could be that have like just headline risk given the administration, right? So and the trend's been telling us that for some time. So we've been pretty much not even watching XLV. The other one, XLRE, real estate doesn't look bad, but it just doesn't look the same as like XLU or XLP.
Yeah,
So
I
staples or
think there's just
utilities.
too much interest rate risk when it comes to XLRE.
Yeah, it's real estate. Yeah, it's the underlying property risk, right? And it's like just cash flow risk and everything like that. Yeah, I think that ultimately defensives don't look bad at all compared to risk. Like I said earlier, look at the Nasdaq, right? Nasdaq kind of has this. If you just look on it on a 1 2, if you go back to like January, it's the same price. Nothing really has happened, but it just has a lot of like short term stretchiness to it. Where like XLU has like this. It's been just basing for literally like 6 months. Look to it, and it could start moving.
Yeah.
Same thing with staples, man. Look, basing, right? So, I mean, this we could see some like defensive breakouts here into June, and those would be very advantageous for RQF given the current allocation. So,
Yeah,
I think
like
that's
if we get any more like slowdown esque news, these are gonna pop. Even risk on news, they're still gonna pop. That's the beauty of
yeah.
it.
So that's a good point. Like, let's just say the system. Look, there's no perfect system. Our system has it tends to be quite sharp and early, but in this case that if it were to be late, right? Let's say it catches risk on later than it should. The reason why we position so interestingly for slowdown periods, right, with these defensive allocations is because in a slowdown, if we're a little bit late to that risk on pivot and we go into risk on, these are still equities. There's still some risk component in here. They're not like bonds, right? So they can go up. They can actually rise with SPY and with the Qs. They might not outperform the Qs or SPY, but you won't get that hard rotation down where like Nasdaq's going right up and staples are just getting destroyed. And I think that's like what makes them so unique and allows us to kind of blend the regimes together and carry positions over from one regime to the next. So yeah, if we get like you said, risk on, any sort of like non-risk off signal throughout the month of June, I think our QF will have some good catch up, a good catch up run here and really reset the scoreboard for the year here. Like we were saying earlier, back half of the year, and this, could very well be the best part of 2025 for us in RQF. Right. Well, thank you guys so much for listening. If you have any questions or want to access our models, go to market-radar.com or find us on X at the Market Radar.